Tired of chasing risky stocks that promise big gains but deliver big headaches? What if I told you there's a simpler way to build wealth? Dividend investing might be the answer you're looking for, especially for beginners. In this video, I'll show you and Harry how 3 powerful dividend ETFs, SCHD, VYM, and DGRO, can transform your financial future. These aren't just random picks. They're carefully selected funds with proven track records for generating both income and growth. I'll show you an ETF with the potential to pay over $5,000 in monthly dividends. And in the end, I'll reveal how a strategic portfolio of these 3 dividend ETFs could potentially make Harry a multi-millionaire with over $350,000 in annual dividends. Many investors struggle with building a dividend portfolio. Should you pick individual stocks? How do you balance growth and income? What if the companies cut their dividends? This is where dividend ETFs shine. They offer instant diversification, professional management, and a steady stream of income. But not all dividend ETFs are created equal. Each has its own methodology, expense ratio, and dividend yield. The average investor faces 3 major challenges. 1. Finding the right balance between current income and dividend growth. 2. Avoiding high-fee funds that eat into returns. 3. Creating a sustainable strategy that works in all market conditions. These 3 ETFs, SCHD, VYM, and DGRO, solve these problems in different ways. Let's dive in. Before we analyze each ETF individually, let's understand the key differences. SCHD, Schwab, U.S. Dividend Equity ETF, focuses on quality companies with a track record of consistently paying dividends. It uses 4 fundamental factors: cash flow to total debt, return on equity, dividend yield, and dividend growth rate. VYM, Vanguard High Dividend Yield Index ETF, tracks the FTSE High Dividend Yield Index, targeting stocks with above-average dividend yields. DGRO, iShares Core Dividend Growth ETF, focuses specifically on companies that consistently grow their dividends over time. Let's start with SCHD, often considered the gold standard of dividend ETFs. With a current dividend yield of 3.74% and a rock-bottom expense ratio of just 0.06%, SCHD offers excellent value. Looking at its top holdings, SCHD includes blue-chip companies like AbbVie, Amgen, Coca-Cola, Pfizer, and Chevron. This ETF holds over 100 individual stocks, providing excellent diversification. The sector breakdown shows a notable concentration in healthcare, 18.2%, financials, 17.2%, and consumer staples, 15%, giving you exposure to defensive sectors that tend to perform well in various economic conditions. What truly sets SCHD apart is its screening methodology. Unlike ETFs that simply chase high yields, SCHD requires companies to have at least 10 consecutive years of dividend payments, demonstrating a commitment to shareholder returns. Next, let's examine VYM, the Vanguard High Dividend Yield ETF. With a dividend yield of 3.03% and an expense ratio of 0.06%, it's another cost-effective option for income investors. VYM's top holdings include Broadcom, JP Chase, ExxonMobil, Walmart, and Procter & Gamble. With over 500 stocks in its portfolio, VYM offers even greater diversification than SCHD. The sector breakdown of VYM shows significant allocations to financial services, 22.9%, healthcare, 11.5%, consumer staples, 10.7%, and industrials, 11.9%. This broader diversification makes VYM slightly less concentrated than SCHD. The key difference is in the approach. VYM focuses primarily on current yield, while SCHD balances yield with quality and growth potential. This makes VYM particularly attractive for investors seeking maximum current income. Our third contender is DGRO, the iShares Core Dividend Growth ETF. With a dividend yield of 2.42% and an expense ratio of 0.08%, DGRO offers slightly less income now, but focuses on companies that consistently increase their dividends over time. DGRO's top holdings include ExxonMobil, Microsoft, JP Chase, Apple, and Johnson & Johnson. With over 400 stocks in its portfolio, It offers excellent diversification. The sector breakdown shows allocations to financial services, 20.87%, healthcare, 18.33%, technology, 17.66%, and industrials, 13.44%. Notice the higher technology weighting compared to the other two ETFs. What makes DGRO special is its focus on dividend growth rather than current yield. To be included, companies must have sustained at least 5 consecutive years of dividend growth and have a payout ratio less than 75%. This positions DGRO as the growth-oriented option among our 3 contenders. Now that we understand each ETF, let's explore how Harry can incorporate them into a cohesive investment strategy. There are 3 main approaches. 1. The single ETF approach. Choose the ETF that best matches your goals and invest solely in that fund. This is the simplest strategy but lacks some diversification benefits. 2. The barbell strategy. Combine a high-yield ETF, VYM, with a dividend growth ETF, DGRO, to balance immediate income with future growth. 3. The 3-fund portfolio. Allocate across all 3 ETFs to capture the benefits of each strategy. This offers the most diversification but requires slightly more management. For most beginners, I recommend starting with the single ETF approach using SCHD as your core holding. As your portfolio grows, you can add the other ETFs to fine-tune your income and growth objectives. The real magic happens when you reinvest your dividends. This creates a compounding effect, what I call the dividend snowball. Let me show you how this works. When a company pays dividends instead of taking that cash, you use it to buy more shares. These additional shares then generate more dividends in the future, which buy even more shares, and the cycle continues. Over time, this exponential growth can transform a modest investment into a substantial fortune. This approach works particularly well with dividend growth ETFs like DGRO, where both the number of shares and the dividend per share are increasing. Let's compare these 3 ETFs across key metrics to see how they stack up against each other. Looking at current dividend yield, SCHD leads the pack with an impressive 3.74%, followed by VYM at 3.03%, while DGRO trails with a more modest 2.42%. If immediate income is your priority, SCHD clearly offers the most attractive option. In terms of expenses, both SCHD and VYM are tied with rock-bottom expense ratios of just 0.06%, making them extremely cost-effective. DGRO comes in slightly higher at 0.08%, but the difference is minimal and still well below industry averages. Examining performance, SCHD shows the strongest 5-year annualized return at 14.65%, with DGRO coming in second at 13.80%, followed closely by VYM at 13.73%. When we look at longer-term performance over 10 years, DGRO edges ahead with 11.4%, followed by SCHD at 11.3%, while VYM lags behind at 10.11%. Regarding diversification, VYM offers the broadest exposure with over 500 holdings, DGRO follows with approximately 400 stocks, and SCHD provides the most concentrated approach with just over 100 companies. This means SCHD is more selective, but potentially more exposed to single stock risk. For volatility metrics, SCHD has a beta of 1.00, meaning it moves in line with the market, while both VYM and DGRO exhibit less volatility with betas of 0.79 and 0.82 respectively. This makes VYM and DGRO potentially better choices during market downturns. Size matters too. SCHD is the largest fund with assets under management of $77.6 billion, followed by VYM with $63.4 billion and DGRO with $31.4 billion. Larger funds generally provide better liquidity and stability. Finally, looking at valuations, VYM has the lowest price-to-earnings ratio at 14.80, suggesting it may contain more value-oriented stocks. SCHD and DGRO have similar PE ratios at 17.74 and 17.82 respectively, indicating they may hold slightly more expensive stocks on average. Each ETF has its strengths. SCHD balances yield and quality, VYM offers broader diversification with solid yield, and DGRO provides the strongest focus on dividend growth. Let's evaluate the pros and cons of each ETF. SCHD pros. Higher current yield, 3.74%. Strong quality screening, excellent historical performance, low expense ratio, good balance of income and growth. SCHD cons. More concentrated portfolio, less exposure to technology sector. VYM pros. Broader diversification, 500 plus stocks. Solid current yield, 3.03%. Very low expense ratio, lower volatility, beta of 0.79. VYM cons. Lower historical returns, less emphasis on dividend growth. DGRO pros. Focus on dividend growth companies, more technology exposure, strong long-term performance, sustainable dividend increases. DGRO cons. Lower current yield, 2.42%. Slightly higher expense ratio, 0.08%. Now let's see what happens if Harry invests $10,000 in each of these ETFs. We'll project the results over 5, 10, 20, and 30 years, assuming historical returns continue and all dividends are reinvested. For SCHD, in 5 years, $17,865 with annual dividends of $668. In 10 years, $31,775 with annual dividends of $1,188. In 20 years, $101,440 with annual dividends of $3,794. In 30 years, $323,845 with annual dividends of $12,112, $1,009 monthly. For VYM, in 5 years, $16,874 with annual dividends of $511. Canadian in 10 years, $28,496 with annual dividends of $863. In 20 years, $81,215 with annual dividends of $2,461. In 30 years, $231,524 with annual dividends of $7,015, $585 monthly. For DGRO, in 5 years, $17,230 with annual dividends of $417. In 10 years, $29,680 with annual dividends of $718. In 20 years, $88,090 with annual dividends of $2,132. 30 years, $261,430 with annual dividends of $6,327, $527 monthly. But what if Harry wants to combine these ETFs to create the ultimate dividend portfolio? Here's a powerful strategy that balances current income, growth, and risk. 50% in SCHD for quality and higher current income. 25% in VYM for broader diversification. 25% in DGRO for maximum dividend growth potential. Let's see what happens if Harry invests $10,000 in this portfolio. In 5 years, $17,459 with annual dividends of $566. In 10 years, $30,431 with annual dividends of $989. In 20 years, $92,546 with annual dividends of $3,045. In 30 years, $285,161 with annual dividends of $9,392, $783 monthly. But wait, there's more. What if Harry invests $100,000 instead of $10,000? After 30 years, his portfolio would be worth approximately $2,851,610 and generating $93,920 in annual dividends. That's $7,827 per month. And if Harry commits to adding just $500 per month to this portfolio, after 30 years, he would have approximately $5,243,958 generating $172,448 in annual dividends. That's $14,371 per month in passive income. So which dividend ETF is right for you? If you want a single fund with the best balance of current income and growth, choose SCHD. If maximum current income is your priority, go with VYM. And if you're focused on long-term dividend growth, DGRO is your best bet. For most investors, I recommend starting with SCHD as your core holding and potentially adding the others as your portfolio grows. Remember, the key to dividend investing success is consistency and patience. Start your investment journey today, reinvest your dividends, and let the power of compounding work for you over time. If you found this analysis helpful, make sure to hit the like button and subscribe for more dividend investing content. Drop a comment below with your favorite dividend ETF. Is it SCHD, VYM, DGRO, or something else entirely?